The S&P 500 just hit a record high on the lowest trading volume in months. GDP crushed expectations, consumer confidence plummeted, and somehow the market celebrated all of it. If you think that makes sense, you're not paying attention to what's actually happening here. Look, I've spent years studying how human psychology creates exploitable patterns in markets. And this week, this is textbook late cycle behavior disguised as strength. The crowd sees 5 straight green days and calls it momentum. I see something far more interesting and far more fragile. So today I'm breaking down exactly what happened this week, why the market's reaction reveals dangerous structural cracks, and how disciplined investors should be positioning for what comes next. We'll cover the psychological trap that's capturing most traders right now, the mechanical forces driving these record highs, and the Stoic approach to navigating markets that have stopped making rational sense. Let's get into it. First, let's examine the human layer, because understanding crowd psychology is how we exploit inefficiencies others can't see. The market absorbed GDP data showing 4.3% growth versus 3.2% expected, consumer confidence falling to multi-month lows, and the Fed signaling fewer rate cuts ahead. The rational response? Risk repricing. The actual response? The S&P 500 climbed to fresh records on volume that was 53% below average. This isn't irrational exuberance. This is path dependency meeting year-end positioning pressure. Here's what's happening psychologically. Recency bias is dominating everything. 5 consecutive winning sessions create momentum conviction that completely overrides fundamental reassessment. Traders see green candles and their brains literally shut off critical analysis. The Santa Claus rally narrative becomes self-fulfilling as institutional managers chase performance into year-end, terrified of underperforming benchmarks in the final trading days. But there's a second force at work: selective attention. Strong GDP gets framed as economic resilience rather than inflation persistence that delays rate cuts. Falling consumer confidence gets dismissed as sentiment-lagging reality. The human mind is remarkably skilled at filtering contradictory signals when it wants to maintain a preferred narrative. And here's the kicker: thin liquidity amplifies herding behavior. With only 7.6 billion shares traded versus a 16.2 billion average, marginal flows from systematic rebalancing create exaggerated price discovery. It's like trying to steer a massive ship with a tiny rudder. Small forces create big movements. The bifurcation tells the real story. The Russell 2000 fell while the S&P hit records. Capital is concentrating in perceived quality, a flight to familiarity disguised as strength. Investors anchor to the Magnificent Seven not because valuations justify it, but because liquidity provides psychological safety. Nike surged 4.6% after Tim Cook disclosed he bought shares. Think about that. A CEO mentions buying a completely unrelated stock, and the crowd follows without independent analysis. This is social proof bias at institutional scale. Now let's examine the system layer, because markets are machines, and machines follow predictable rules. The system absorbed contradictory inputs and produced coherent outputs through liquidity-driven price formation. GDP exceeding forecasts by 110 basis points should have steepened the yield curve and pressured duration-sensitive equities. Instead, the 10-year Treasury held at 4.14%, and the S&P added 22 points. This inversion of expected causality reveals market structure, not market sentiment. Systematic strategies, volatility targeting, risk parity, trend-following CTAs remain net long equities because realized volatility stayed compressed at 13.47 VIX. Low volatility begets larger position sizes, which suppresses volatility further. It's a reflexive loop that works until it doesn't. The sector rotation is telling. Money flowed into financials, industrials, and materials, while defensives lagged. This happened simultaneously, with consumer confidence falling 3.8 points and jobless claims showing labor market fragility. The contradiction resolves when you understand institutional rebalancing. Asset allocators are mechanically correcting underweight cyclical positions regardless of near-term macro signals. The Russell 2000's 0.6% decline while large caps rallied confirms this. Small cap illiquidity makes them unsuitable for large institutional flows, so they get sold to fund large cap purchases. It's mechanical, not fundamental. Commodities fragmented along use case lines. Copper hit $12,000 per ton on structural electrification demand. Gold and silver reached all-time highs despite a stronger dollar. Central bank accumulation overwhelming traditional correlations. Oil fell to $56 WTI on demand destruction fears. The commodity complex is sorting by function: industrial metals for growth, precious metals for insurance, energy for recession hedging. Here's what's fascinating about the Fed's 25 basis point cut. It was fully priced. The dot plot showed fewer 2026 cuts than expected, yet equities didn't sell off. The market has stopped trading Fed policy and started trading liquidity conditions. This decoupling should terrify anyone who understands how these cycles end. Now for the Stoic interpretation, because discipline separates exploiters from the exploited. Record highs on record low volume during contradictory macro data is noise masquerading as trend. The edge lies not in predicting direction, but in understanding the fragility embedded in this structure. 5 consecutive up days with VIX at 13.47 creates asymmetric risk. The downside from complacency exceeds the upside from momentum continuation. When 53% of normal volume produces 0.3% S&P gains, normal volume could produce 0.6% moves in either direction. Volatility compression stores energy, it doesn't eliminate it. The gap between 4.3% GDP growth and consumer confidence at 89.1 will close through one of two paths. Either sentiment improves as labor markets stabilize or production slows as consumption weakens. The market priced the former while data suggests the latter. This is extrapolation, not analysis. Gold at $4,555 and Bitcoin at $87,000 represent competing visions of monetary disorder. Gold's 54 record closes reflect institutional adoption of a 5,000-year store of value. Bitcoin's 30% drawdown from peak reflects speculative exhaustion. Anti-fragility requires time-tested resilience, not narrative-driven adoption. The concentration in mega-cap tech while small caps decline isn't market health, it's market exhaustion. Breadth deterioration precedes trend reversals because it reveals the narrowing base of support. When capital flees complexity for simplicity, illiquidity for liquidity, that's late cycle behavior. Here's the Stoic approach. We don't chase records into year-end on sub-average volume. We don't extrapolate 5-day winning streaks into January trends. We observe that markets climbing walls of worry eventually run out of wall. The current structure, record valuations, compressed volatility, deteriorating breadth, contradictory macro signals, holiday liquidity, doesn't invite participation. It invites patience. The next high-conviction opportunity emerges when price, volume, and volatility align with structural catalysts rather than calendar effects. Until then, the discipline is simple. Do nothing and let the system reveal its hand. This is exploitable because human nature is predictable, market structure is mechanical, and discipline is rare. The crowd reacts emotionally to 5 green days and calls it strength. We see fragility disguised as momentum and prepare accordingly. The system rewards those who think in probabilities while others think in predictions, who understand structure while others chase price action, who remain patient while others chase performance. If you value systematic thinking over emotional noise, hit that subscribe button. The link in the description contains the complete framework for exploiting human psychology through disciplined market analysis. Because in a world of predictable irrationality, the greatest edge is simply refusing to participate in the madness.